we want to thank them for sponsoring the seminar. Today's speaker has been in Forbes magazine. You may have seen her in Forbes magazine. She's an expert tax and business strategist and enrolled agent. She's licensed to represent taxpayers in all 50 states. And on something that's a little different from most tax people, she has a master's degree in taxation and business development. So she's gone a little further than just learning about taxes in that area. She's author of 2 books also, Tax Storm and Against the Odds. Do we have any of those books here today?
No.
No, we don't have the books here today. Okay, if they go on the line, can they find those books?
They can.
They can, and where should they go online if they're going to find them?
They can go to Amazon.
Go to Amazon, okay. One is Tax Storm, the other is Against the Odds. She's CEO of the consultancy firm of Carla Dennis and Associates. She saved her clients. If you're a client, she saved you probably thousands of dollars. She's also been featured in various media outlets, such as, I've mentioned Forbes, MSNBC, Yahoo, Finance and Smart Money, making her the ultimate tax speaker for you guys to figure out how to save all that money that you're making. It's a real pleasure to introduce to you Miss Carla Dennis.
Thank you.
It's all yours.
Good morning.
And I'm going to ask you to hold your questions as she's going along. If she ignores you, have your sign set up. She wants to. She's doing it because she's been instructed to. So please hold it after she finishes giving you all the information, and we'll probably eliminate half of those questions through the information. We'll have you come up and ask questions up front here.
Thank you so much. Good morning, everybody. How are we? I am going to put my timer on because I could literally keep you guys here till 5:00 p.m. talking about taxes. So I want to be respectful of your time, and I'm going to time me so that I can leave you guys an opportunity to ask me questions at the end. Would that be okay?
If you did that, some people would stay.
They would stay?
Yeah.
I bet you I could keep them here. We might need to bring in a little bit of lunch, right? Put some food in our stomach, because that's important. All right, good morning. I am Carla Dennis. It is my pleasure to be standing before you. It's also my pleasure that you guys came out and in this rain, I want to say almost sleet and snow, right? I had to come in from Orange County, so that was a bit much. But I did the smart thing, and I stayed up here last night, so don't pity me too much. It is a pleasure to be here with you. I want you guys to walk out of here with 3 things. And if I give you those 3 things, I feel like I've done my job. Number 1, I want you guys to walk out of here knowing about the new tax laws and how they're going to affect you. Number 2, I want you guys to watch out for the traps that are in the new tax laws that you may not have thought of. And number 3, I want to give you a solution on how you can write off almost anything under the new tax laws. Would that be okay? Yes. If I did those 3 things, I think I would feel better about that commute back to Orange County. All right. So I am Carla Dennis. I am the CEO of Carla Dennis and Associates, Inc. I eat and sleep taxes. I love what I do. I know that may sound odd for a lot of you guys, but I do read the tax code. I read the tax code for fun. I was reading the tax code actually on Christmas Day. When the new tax laws passed, I was the girl that stayed up all night, got a copy of the new HR Bill 1, and read it all the way through because I was determined to understand it. I get a lot of media hits, but most importantly, I have a clientele that I want to make certain that I am in front of them when it comes to the new tax laws, that I advise them so they're not out there floundering and wondering what's going on. This has been literally a massive overhaul. When I was studying to get my enrolled agent license back in 1987, they had just had the Tax Reconciliation Act of 1986. So this is a major overhaul since then. So it's very intriguing to me to see what was going to happen. And when I tell you that this is a major overhaul, this is really a major overhaul. And I wonder if the people on the Ways and Means Committee, which I think I should be on that committee, honestly, the people on the Ways and Means Committee, do they really know what they were doing? You know, I researched those people. I don't know that any of them have a tax background. That's one thing. Number two, is the IRS up to speed on the new laws to get all the forms and the calculations done correctly? And number three, are we in the tax community up on these new laws? I can tell you they're being clearly defined as we stand here. Treasury regulations are being put together. There's going to be a lot of case law over it. So I don't know that we're going to know 100% of what's going on with these new tax laws. But I do study it. Before me here is my team. I have a team of 16 other tax professionals. A few of them are in the room. And so what I do is I make certain that we know what's happening with these new laws. It is a lot of changes that is going to really, what do I want to say, increase your tax bill. How many of you thought that these new tax laws were going to lower your tax bill? Okay, so a few hands, be proud of that, right? That's what they told us. They told us that the new tax laws were going to lower our tax bill. At least that's what I heard. They said they were going to cut millions of Americans. They're going to see bigger paychecks coming home. Was that not what we heard, right? And so it makes me think, okay, what exactly did they mean by that? Because I've run calculations, and I can tell you as I stand here before you that you're going to see a tax increase. I think that there's going to be a benefit for people that may need it, some people that may be in a little bit lower income bracket that maybe do need a break. But I can tell you for the majority of us, property owners, people that own their own businesses, the people that are sitting in this room, you're going to see a tax increase. That's for sure. So let's talk about some of those law changes. The laws went into effect at the end of December 31st, 2017. It's impactful this year when you file your 2018 income taxes, right? That's when it's going to take place. I am going to tell you there's going to be a lot of guidance needed, and there's going to be a lot of future legislation. The states have not conformed to the federal law. The states have not conformed to the federal law. So there is going to be a federal to state tax difference for all the states right now. So that's one thing that I want you guys to be aware of. Very important to see how the state of California is going to treat this federal law. Typically, the last time they had the tax law change, and don't quote me on this, but I would say it took California 13 years to conform to the federal law after the TRA 86 law. So we're going to be a long time out before they catch up. So that's going to be very interesting. And if that wasn't enough, we have a government shutdown, right? That's all wonderful and great, especially for the people in the tax world. So how do you guys think this government shutdown is going to impact you from a tax perspective?
Everything would be slower.
Everything will be slower, as if it wasn't slow enough, right? Right? How else?
The training of the agents is not up to snuff because they haven't been to work to get trained.
Yep, the training of the agents. How about the delay of your tax forms? The forms that are not quite ready, that are in a draft form right now. How about your estimated tax payments that were due on January 15th? I guarantee you those checks will get cashed, but they won't get applied to your account, right? That's going to be an issue because those checks go to a lockbox. So they're getting cashed immediately. That's a bank. The checks go directly to the bank. People think they go to the IRS, but that is an actual lockbox in a bank to make certain that your checks are cashed immediately, right? I guarantee you, if you go look, your check has been cashed for sure, right? So we're going to be affected by that. What about the fact that if you are one of those individuals that is possibly getting a tax refund, which I hope you're not, I hope nobody in this room is getting a tax refund, right? Not because I want you to owe tax, because I don't want you to overpay tax. I don't want you to ever be in a position where IRS has to refund you your money. I think you should be very smart on with that, and that you should only pay what you owe them and no more. Because now with the government shutdown, how about your refund is going to be sitting there, right? And they hold on to refunds anyway. So the new rule is if your refund is over $2,500, IRS has the right to hold it and further investigate the refund. That's the new rule, and that rule was effective last year. So we don't want IRS to withhold our refunds, so we don't even want to get refunds. That's the first strategy. All right, so the government shut down, I think we're in the 24th, 25th day of 27th. Wow, I'm behind. It's the 27th day. It's going to be extremely interesting to see what happens, honestly. This has been the longest government shutdown. We had a shutdown in 2013 that affected tax season, but nothing like this. So it'll be interesting to see what happens from that perspective. But let's talk about a couple of the changes. So we now have 7 tax brackets. There's always been 7 tax brackets, but those 7 tax brackets have been decreased a little bit, so that we're going from the 10% tax bracket to the 37% tax bracket. There is no more dependent exemptions. So if you are writing yourself off on your tax return, that $4,050 that you get as an exemption deduction for yourself, for your spouse, for your kids, that's no more exemption deductions, right? There's a higher child tax credit that has been increased now to $2,000. I was a little disappointed in that. I have 4 sons. And now that my sons are going to be 17 and above now, they increased this tax credit to $2,000. I think that's interesting. We now have a dependent care credit. For those of you who carry your parents, maybe a relative, now you can get a credit for them up to $500. Please know that all of these credits, of course, have income limits attached to them. So just be aware of that. There's been an increase in the standard deduction. So those itemizing maybe did have their own primary residence, the standard deduction has now been doubled. So that's at least a benefit to those individuals who can take advantage of that. In addition to that, we also have some other changes. There's been a repeal of the overall limitation on itemized deductions. That's no longer a cap. The medical deductions, you still have to exceed 7.5% of income, but starting this year in 2019, it needs to exceed 10% of your income. 10% of your income. This is one law really that I really wish they would change, because medical insurance is extremely high for a lot of individuals, and the out-of-pocket cost is really high, and I just think that should be a straightaway deduction. That's just a personal opinion of mine, but I just feel like that should go away. The mortgage interest cap. We've always had a mortgage cap of $1 million, right? So if you had a primary residence, and this is only 2, a primary residence. Excuse me? It was $1 million. And then the 1 comes in with the equity line, to answer your question. So we've always had that cap, and now that cap has been dropped to $750,000 for primary residence. This is going to impact California, New York, New Jersey, the states that have really high property values, right? I think it's not going to impact the sort of like the middle states, but it does impact a lot of the other states. In addition to that, we have a cap on state and local tax. State and local tax is capped at $10,000. That means your property taxes, your state income taxes, your DMV fees, your property taxes on a second home that's not a rental is capped at a $10,000 write-off in the aggregate. Are you guys with me on that? All right. Did you say no?
Yeah.
Okay.
I said no.
No, you're not with me. Okay. So let's say, for example, you own a primary residence and you have your property taxes. And let's say that your property taxes for the year are $7,500. And then let's say you may have maybe another $4,000 state income tax that you're trying to deduct, correct? That's $11,500 total that you normally can write off on Schedule A as an itemized deduction. That's now capped at $10,000. So you're going to lose $1,150. Okay?
Another year?
That's really interesting. I don't know that yet. That hasn't clearly been defined. But that's one of the things that we're really interested to see. Typically in the past, when you have a limitation, it does roll. But I don't see anywhere yet where this is going to roll to the next year. But that's a really good question. And we will see what happens. Also, miscellaneous itemized deductions are no longer deductible on the federal side. On the federal side. I want, there's a state, different client emailed me yesterday. He does a lot of real estate investment, and his financial planner told him, oh, you don't need your investment fees this year. And I emailed him back and said, yes, you do, because they're deductible on the state. So this is where I'm telling you, a lot of people really don't know how these laws are going to be impactful across the board. If you do have investments, you do need your investment fees, because those investment fees will be deductible on your state income tax return. All right? Okay, so what else are we looking at? That means your unreimbursed employee expenses, if you have 2106 expenses. A lot of our first responders, firefighters, police officers, nurses, they have that. Tax prep fees are no longer deductible. Hobby expenses, investment expenses, legal fees, all of these items are no longer deductible in your federal return. Does that mean that you no longer capture them?
But they're good on the state.
Because they go on the state, so you still need to track them. You still absolutely need to track them. But just know they will not be deducted on the federal return. Okay. Business changes. The corporate tax rate is at a flat 21%. That's on a C corporation. Does anybody know why that law got in there? That 21% on corporate tax? Who championed this law? Does Trump have?
That was under Reagan.
Okay, but hold on one second. This law right now that just passed, it passed under the Trump administration, right? And so a lot of the people that worked on this tax law, I guarantee you these big businesses are C corporations. This is a big tax drop for a C corporation. They repealed the AMT, the alternative minimum tax for corporations, not for individuals. That's really interesting to me. Now, what they did give for business owners is a special flow-through deduction. Are you guys familiar with the special flow-through deduction at all? No. The 20%? All right. How many of you guys in here own real estate? Okay. How many of you own real estate in an LLC? A few of you. All right. So if you own real estate, this applies to you. This 20% flow-through deduction applies to you. And let me tell you what that is. That says that if you have any business income, is real estate a business? Yes. All right, very good. I'm glad we're clear there. If you have any business income that's flowing through to your personal income tax return, you're going to be able to take a 20% deduction from income. You're going to be able to take a 20% deduction from income, right? That applies to you. Now, hold on a moment. We got to be very careful. We need to be very careful because there are some traps with all of this that I want you guys to know about. You guys that know about that 20% deduction, and that could be huge for you, but you got to make sure you get that calculation correct. So let's talk about some of the traps. I'm going to explain to you what you need to know about the 20% deduction so that you guys can possibly take advantage of that. The first trap that I want to talk to you guys about is claiming dependents. We want to be really careful. That exemption deduction, right? That $4,050 per person deduction that we get for carrying our spouse or kids, let's be careful. Should you still claim your kids on your tax return? Anybody? Yes. Why? Because it could affect you for medical purposes, college applications, the child tax credit, the dependent care credit. I've already had clients coming to me saying, Carla, because I don't get an exemption deduction for my kids anymore, can I just let my college kids who have a part-time job go ahead and file their own tax return? Yes, but don't let them claim themselves. They still need to be a dependent on your return for other purposes. Very careful here, because you could lose out on certain credits, certain benefits. Are you guys following? I want to be real clear. So the law says right now in 2018, if you are filing a tax return, and let's just say I'm filing my tax return, Carla Dennis, I have 2 sons that are left on my tax return. I have 2 sons I kicked off because they're grown now, right? You're on your own. I have 2 sons that are left on my tax return. One's in college, and he does have a part-time job in college, and one is in high school. And so I would normally get a $4,050 write-off for each one of my children. So that would be $8,100 for each one of my kids, correct? Now that my kid has his own job and I don't get that deduction anymore, should I still put him on my tax return? Should I still put his name listed on my tax return?
Yes.
In my particular case, yes. For medical purposes, for different reasons, in my case, yes. But everybody has to vet that out for themselves. Because maybe for you, it's not about medical expenses. Maybe it's not about college applications. Maybe your kid doesn't qualify anymore for the child tax credit, right? If they're over 17, maybe they don't get the child tax credit. So maybe your kid could go by himself, just maybe. But that's what you got to figure out. It's not a black and white answer to that. That's my point to you. It's not definitive anymore to say, yes, you need to ride with me, or no, go be on your own. You need to clear it up, yes. You know what? I'm sorry. They asked me to hold all questions to the end, so let me be respectful of the entire audience. I will get to you afterwards, okay? So we just want to make sure that we don't just go business as usual. That's the takeaway. You guys follow? All right. Trap number 2, that 20% business income deduction. The 20% business income deduction. I would think that 20% business income deduction, it says you could get a deduction where you could take 20% off of your business income. 20%, okay, we learned this math in 3rd grade. It's not that difficult, right? However, the calculation is about this many pages thick on how to get to that 20%. It is absolutely amazing to me that has so many different rules associated with that 20% deduction. And so this is what we have to be careful of. It's not just a flat 20%. There is a complicated calculation involved. They have to look at the value of your property. They got to look at whether or not you have payroll, don't have payroll. Are you in a service industry? Do you have another business that's in a service industry that's connected to this business? It's not that simple, all right? I want you to be aware of that, and I'm going to highly recommend that you talk to your accountants and get that figured out. You're going to need to have your balance sheets for your businesses. You're going to need that information now. That's going to be very important. If you are in an entity, if you have an entity like an S Corp or an LLC, if you have put yourself on payroll before the end of the year, you probably would have automatically got the full 20%. It's a whole trick to it. I want you guys to be aware of it. Is that making sense? Okay. Know that you could potentially get it, and know that you need to talk about it to make sure that you get the calculation correct and that you maximize the calculation. If there's 20% to be had, we want to get all 20%. All right? Are you guys with me so far? All right. The next deduction, SALT. SALT stands for your state and local tax. SALT stands for your property taxes, your state income tax, your DMV fees, the property taxes on a second home that you may be carrying on your Schedule A. That's what SALT stands for. In our industry, we call it SALT tax. Okay. There is that $10,000 limitation on the SALT tax. Now, here's the thing that you have to be very careful of. If you deduct state income tax and you get a refund, what happens the next year?
It's taxable.
You get taxable. You get that 1099-G form, correct? Yeah. We all seen that before in the mail. So we want to be careful of creating taxable income for ourselves. We want to be careful of creating taxable income for ourselves. So if you have to choose, what you want to do is deduct your property taxes first. Deduct your property taxes first. So if you have, let's say, $7,500 in property taxes and maybe another $7,500 in state income tax. I don't know, I'm just throwing out numbers. Take that $7,500 in property taxes first and then fill in the other $2,500 with the state income tax. You got it? You got it? Okay, I don't see heads nodding. Now let's go over that again. All right, so in that little area of Schedule A, are you guys familiar with Schedule A? All right, so when we're on Schedule A, we have our medical expenses at the top, and then we drop down to our state and local tax. You guys with me? In that area where we're deducting our state and local tax, we're deducting pretty much three things in that area, right? Property taxes, state income tax, and our DMV fees, and maybe property tax on the second home. You want to make certain that you take your property tax deduction first. Take that deduction first because you only have a bucket of $10,000. Fill it with the property tax deduction first, and if you have anything less, then put the state income taxes in the bucket. You follow me? Mm-hmm. You know why? Because the state income tax becomes taxable the next year if you get a refund. Property taxes does not become taxable the next year. So we don't want to artificially create income tax for ourselves if we don't have to. You guys follow me? Very important. I'm pretty much willing to bet that you're going to have to tell your tax professionals that. Make sure you tell them that. That'd be a cute little trick to tell them. So I want my property taxes deducted first. Very important so that you don't end up with taxable income. All right? All right, the next trap that I want to talk to you guys about, meals and entertainment expenses. How many of you guys deduct meals and entertainment on your tax return? That's it? The rest of you guys don't eat? All right. What did you say? You're chicken? All right. We're going to get rid of people being chicken of the IRS, right? People are, I think the majority of people fear IRS. I get it. I understand why. But hopefully, after this presentation, we're going to knock some of that fear down a little bit, right? I don't want taxpayers to fear IRS. I don't think you fear IRS. I think you fear what you don't know about IRS. That's really what it boils down to. You really fear that. Okay, meals and entertainment. Entertainment is no longer tax deductible. Entertainment is no longer tax deductible. So, how many of you guys have businesses aside from your rental property? Anybody? A few of you do, okay? If you are entertaining people, what are you really doing?
Business sales.
You're really doing business sales. You're marketing. You shouldn't have had entertainment on your return anyway. It's marketing. Do we really entertain clients? Or do we really, is that part of like a marketing type of thing, right? Or sales type of thing, a relationship building type of thing. So all of that should really go into your marketing category. Make sense now? Yes. Let's just eliminate the term entertainment, but let's keep our deduction, right? All right. Now, one thing that I'm going to ask you here, I'm just going to ask you this question. We're going to answer this question as we go forward. And I'm just going to ask it, and I just want you to start to think about it. Who decides what your tax deduction should be on your return? And who decides whether or not they're legitimate or not? Just something to think about. Hold that point. All right, details. So entertainment is no longer deductible. Meals can still be deductible. Client meals, traveling meals, all of that still should be deductible. So if you have meals or whatever you're doing, make sure that you guys are deducting all of that on your tax return. Very important. Watch the categorization of your expenses on your tax return. That's real important. Watch the categorization of your expenses on your tax return. If it feels or sounds like entertainment, don't deduct it, right? We don't want the IRS employees that work there, bless their hearts. My best friend works for the IRS. Believe it or not, she and I went to high school together. She's one of the top IRS agents, and I pray for her every day. Every day. She works for Internal Revenue Service, and Internal Revenue Service is very interesting. What I can definitely tell you is that the frontline people don't know as much as we think they know. They're typically new out of school individuals. So we don't want to give them too much credit so that they can understand what we're putting on our tax return. We want to make it very simple. We learned everything we needed to know by the time we got to third grade. If it's beyond that level, we need to break it down. Honestly, we need to break it down. And I'm going to talk to you guys a little bit more about that. All right. So let me tell you what I typically see in a transition year like this. And we are in a transition year. We're in a transition year with new tax laws. We're in a transition year with the government being shut down. And let's not even talk about all the other things that are going on in our world, right? We're just in a transition year. What I typically see in a transition year like this is I typically will see two kinds of taxpayers that are going to come to me. There's going to be two of you. Do you guys know what those two are? Who said that? The knowledgeable and the unknowledgeable? Yeah, but they don't display it exactly like that, right? It is the knowledgeable and the unknowledgeable. I love that. It is the person that's going to come to me and say, Carla, I don't care. I'm going to write off everything. I'm going to write off my veterinary bills. I'm sick of this government. Blah, 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 blah. And they're just going to try to write everything off on their tax return.
That's me.
That's you? Okay. But you don't come to me, right? Okay. All right. So that's that person. They're like, I'm just done with it. I'm writing off. I'll take my chances. I don't care. And then we have this person, the ultra-conservative person that says, oh, I don't want to throw any red flags. That looks like it's too much, honey. Take that off my return. Let's back those expenses down. I have the receipt, but it looks like it's blanked out a little bit. I don't know where that receipt is. Oh, I'm kind of scared. I'm not really certain. Let's just toss that one. Does that even sound like anybody in here? Yeah, right? Absolutely, right? It's like, just forget it. I don't want to cause any attention to my return. IRS got my name. They've already sent me one letter. Right? They've already sent me one letter. I'm on their list, honestly. So the thing that I will tell you guys is I want you guys to just get rid of all of that thought process. IRS, it's not personal, right? Honestly, if I get a client, sometimes I have my nervous Nelly clients. If they get a letter from the IRS, they're like, Carla, why did they send it to me? Has this ever happened to any of your other clients? Am I on a special list? Oh my God, how do I get off the list? I'm like, honey, calm down. You're not on a special list. Honestly, it's not personal. So, what type of taxpayer should you be? Should you be ultra aggressive? No. Should you be conservative? No. All right, wait, hold up. I got to know. Who thinks we should be ultra aggressive? This gentleman, put your hand up. You don't get to back out now, right? You don't get to back out now. Who thinks we should be conservative? All right? A few of you think we should be conservative. I think we should follow the law exactly as it is, right? How many of you follow the law on a daily basis? Oh, that's not a lot of people raising their hand. Are the rest of you guys criminals? What is happening in here, right? How many of you guys follow the law, right? Okay, every now and then when you get to that yellow light, you may speed up and not slow down. But for the most part, people want to follow the law. Would you agree with that? Yes. I think that most people want to follow the law. I think that most people don't follow the law because they don't know what the law is. It's not intentional, right? Because if it becomes intentional, that becomes an overt act. And if that becomes an overt act, that becomes a criminal thing. And please don't call Carla, right? So we want you to be taxpayers that follow the law. That's the key. We don't want to be aggressive. We don't want to be conservative. I just want to know what the law is, and I will follow that exactly as it is written. Okay? So that's what I want for you guys. And there is truly 4 simple steps to follow the code, the Internal Revenue Code, IRC, Internal Revenue Code. How many of you guys knew that there was an actual tax code? Okay?
It's a big, thick book.
It's a pile. It is big, thick book. It's a lot of pages, thousands of pages, and then the interpretation of the tax code is sort of like the Encyclopedia Britannica. Do you guys remember that? I don't know anything about that. My parents told me about that. Just kidding. All right, so 4 simple steps to follow the code. And I want you guys to get this because I want to make sure you know it, all right? Step number 1, if you really want to drop your taxes down legally, stay in compliance, follow the law, I'm going to tell you there's 2 paths to it. There's the path that you have the basic W-2 wage earner on, where all of their to the IRS, their W-2s, everything goes to the IRS. And then there's the other path that the majority of you are on because you guys have rental property, right? So, number 1, you have to have a business. How many of you in here have a business?
No.
How many of you in here have rental property? So that should be the same number of hands. If you have rental property, you have a business, whether you want to accept it or not, right? When those tenants call you, probably like, no, it's not my property, don't call me. But honestly, if you have rental property, you have a business, whether you want it to be or not. IRS classifies that as a business. It may be a passive business, but it's still a business, okay? So if you have that, what you want to make sure of that you spend some time in that business. Very important that you do that. You have a mentor or a coach. You guys all belong to AOA. AOA provides you guys with knowledge, mentorship, right? And then you guys have a strategy. Let me tell you why that's important. And I want you guys to start keeping a journal, whether you keep it on your iPads or whether you write it down on paper. I want you to start keeping a journal of your business. And let me tell you why this is so important. When you journal your business and you keep track of what is going on in your business, typically you're pretty serious about your business, right? If you're doing that. Journals have 1 cases for me. When clients have taken the time to make notes of what they do in their business, I can tell IRS, this client is serious, because if he wasn't, or she wasn't, she wouldn't journal. She wouldn't write down, tenant called me today about the sink clogged up, the same sink that we unclogged 2 weeks ago. I don't know what those people over there doing, that type of stuff. Write it down in your journal. I am telling you, these journals will save you in the event of an audit. They will definitely save you. So, what'd you say? Exactly, or a lawsuit. Absolutely. They will save you. So journal. If you are relying on your memory, then I want to know what it is that you guys are taking or eating, because I can't rely on my memory anymore, right? So I write things down. Very important. That's step number 1. You must have a business. Step number 2, your business expenses must have a purpose. They must have a purpose. Now, remember that question I asked you? I asked you, who decides whether your business expenses are deductible and whether or not you can deduct something on your tax return? Who makes that decision? Who believes we do? I want to see a show of hands. Okay? Who believes the IRS makes that decision? Come on, people. I only gave you guys 2 options. All right. So you believe the IRS. Who believes IRS makes the decision? Okay? And who believes you make the decision? All right, very good. So let me tell you who makes the decision. Code section 162. Take me on that yacht, honestly, right? Okay, so she went out and she bought a yacht. Do you guys know how much yachts cost? They're very, very, very expensive. Did I say very expensive? Yeah. Okay, they're very expensive. So she bought a yacht and she wrote that yacht off on her tax return. Whoa. Right? Whoa. That's what IRS said. Whoa. They were like, oh, honey. So they knocked on her door. And when they disallowed that tax deduction, they disallowed it for the year that she wrote it off the first time, the year before, and the year after. They open up all 3 years of tax return. So sometimes when you're audited, let me just tell you guys something. If you're audited and we don't contain that audit fast, right? And we don't have a minimum change, they will open up the year after and the year before. So they open up 3 years on her. And when I tell you they opened up 3 years on her, she owed back a ton of money to IRS. And we're talking probably, I want to say it was over $300,000 that she owed back.
Didn't you get her out there?
I did. IRS wanted their money though, right? And so she had gone to 2 other tax professionals, and by the time she got to me, she had a little bit of attitude, which is always the case. I know you go, what? But it's typical, because if they're going to other people, they're frustrated. So it's not a personal thing. They're just like, I don't know if you can help me, but I was referred to you by somebody. You know how they act, right? I'm like, okay, girl, calm down. We're going to see what we can do. But I get it. She's upset. She owes back this much money. She doesn't have it. You know, IRS is on her, and she has a license. So if IRS disallows it, it's going to go to the state, and then the state's going to disallow it. So I got to know the client a little bit and really said, you know what? This is part of your brand. This is ordinary and necessary for your business. So we got a copy of the people that were on her yacht, because when you have a yacht, you have a captain, and they keep track of everybody that gets on that boat. Did you guys know that? I didn't know that because I don't have a yacht. So they keep track of everybody's on the boat, and we were able to link the fact that somebody that was on that boat brought property from her or referred her somebody that brought property from her. Got it? We linked that write-off to the pursuit of income. Code section 162 says we can do that, IRS, right? We were able to get that tax deduction stay on her return. This is what I'm talking about, understanding the law. The auditor looked at me like, what are you talking about? I said, I'm talking about code section 162. That's what we're talking about. And we went back and forth, but I am relentless. I am like a bulldog with a bone that is hungry, honestly. So I just know that I stand firm in the code so that taxpayers can make sure that they get their tax write-offs. Very important. So just because the IRS says you can't take that tax write-off, and they walk up on you, you can't take that tax write-off, and your eyes get really big and go, okay, and you got to push back. Because what is the IRS? They're a collection agency for the government. It's their job to tell you you can't take the tax write-off. But you got to hold the line and push back. Are you guys with me? Yeah. And you guys are going, oh my God, I'm not going to push back the IRS. Yes, you are. Yes, you are. Because Publication 1 gives you Taxpayers' Bill of Rights. Don't forget that. Taxpayer Bill of Rights says you have the right to representation. That's so important for you guys to know that. So that if you can't handle IRS, then you hire somebody who can. Because they are trained to disarm you. I kid you not. I really feel like when taxpayers get in front of IRS, like they get very loose lips. It's almost like they get that true serum, right? If IRS is in front of you, it's almost like they've given you true serum and you just start talking, like rattling off really fast. But the key is that you do have some rights. And you have the Taxpayer Bill of Rights, Publication 1, and you guys have Code Section 162 that says you get to write off what's ordinary and necessary for your business. Got it? All right. So, what did I tell you step number 2 was? You got to have a business, and it must have a business purpose. Your expenses, a business purpose. You decide what that purpose is. Step 2, you got to have proof of payments. Stop throwing away your receipts. Stop balling them up. Stop thinking, oh, well, it's on my American Express bill or my Capital One bill at the end of the year, so I don't need the receipts, right? How many of you guys do that? I know you do it. Don't do it. Keep your receipts. Why do you need to keep your receipts? Because the law states that you're supposed to have your receipts. So we want to follow the law. I can't go to the IRS and say, my client is following the law with Code Section 162 and then walk over here and go, but he doesn't follow the law when it comes to the receipts. That doesn't work. You follow me? So I want to make sure that you can get all your tax deductions, and you can get all your tax deductions if you follow the law. Keep track of the receipts. Take a picture of them. You guys pretty much all have smartphones, right? Take a picture of your receipts. Because some of you guys say, well, they fade, they get lost, they're in the shoebox. They're my email, right? That's a new thing now. These companies email you receipts, right? And we all go, oh, it's in my email, right? Until the email crashes or you can't find the receipt when you need it. Every single time you're looking for something, it'll just crash or whatever. Something will happen to it. Keep track of your receipts. Very important. I am a very anal person. I print all of my receipts. I have all of my stuff on paper.
For how long?
I have my stuff for like, my husband is so sick of me. Like he wants to throw out my boxes, but I won't let him. So I probably have my stuff going back to like 83. I have my stuff for a very long time. But I'm a little over the top.
Yeah.
So I would say that if you own rental property, we know we got to keep those HUDs and things like that from the first time we bought that property, right? I just like to keep documents. I don't ever want to be looking for something and can't find it. So I'm just real anal about things like that. So I keep all of my stuff. But I would say for you guys, as a rule of thumb, 7 years. Keep your stuff for 7 years, but keep all of your closing statements, refinance statements unlimited.
I found a piece of paper on it, and there's a 10-year statute of limitations and saved me $124,000.
Yep.
I wasn't anal before that, I got much worse after.
That's right.
One piece
That's
of
right.
paper with proper.
That's right. You got to keep your paperwork.
And it was 10 years.
Yep, there is. That's right. They could go back 10 years on you. Mm-hmm. Keep your paperwork. Very important. And they will ask for it. Believe me, they will. All right. So proof of payments. Track everything. You guys have phones. Take pictures. Print stuff. Remember back in the olden days when you guys were all coming up? I don't remember this, but when you guys were all coming up, you know how we used to have photo albums, right? And people would go to your house and you'd see photo albums, right? And so now we've gotten so into these iPhones, we never print our pictures anymore, right? We got a million pictures, but nobody can enjoy them because they're stuck here. Get those receipts down on some paper. It's great if you have backup copies, but get them on some paper so that you have it. And just label it 2018, 2017, whatever you need to do with it. They have these scanning services. Have them scan it and put it in a vault somewhere for you, right? So at least if they lose it, you have somebody to sue or something, but keep track of your stuff. All right. Make sure that your expenses are properly reported on your tax return. Amazon is not an expense category. Home Depot is not an expense category. Lowe's is not an expense category. Office expense is not an expense category. Those aren't categories. I see that often on tax returns. You do not want to give IRS a reason to question that category. Can someone tell me what office expense is? Supplies? Coffee? So it's a printer. It's supplies. It's what else? It's a computer. So in office expense, we got computers, we got printers, we got office supplies, we got office space. See how dizzy I am? No. Office supplies go into office supplies. Computers and equipment goes under equipment. Put it under the proper category. Delete office expense. Delete that term. That is like one of those terms, that's like a bucket for just everything goes into, that's a new miscellaneous category, right? Office expense. Get rid of that. Be very clear so that you don't have to worry about IRS wondering what your categories are. We don't want to give them a reason to ask a question. Also, try to stay away from big categories, like big lumps. Sometimes I see tax returns and I'll see repairs, $20,000. Okay, I'm guaranteeing you that's going to flag someone to question it. Now, let me explain something to you about flagging tax returns for audits. There's this thing called a diff score. Your tax return may be flagged for audit and you don't know it. So if you get 3 diff scores, meaning your return differs in 3 categories from someone else in a similar situation, your return gets pulled down for a visual look at it, okay? Whether they choose to take you to an audit or not is up to decided by the IRS. But you don't even want to get a diff score. So drop your expenses down to smaller categories. I would rather you have repairs, electrical, $1,200, repairs, plumbing, $2,000. I would rather those categories be a billion small categories than one big category. Make sense? Don't give them a reason to question. You guys with me?
Yes.
All right. Now, here is some of the most common nuances that I see. Not keeping proper receipts. That is notorious. I had a client come in my office one time, a brand new client, and he came in, he had a little folder. I was like, oh, this guy is really organized. And then he said, Carla, do you have a dolly? I said, a dolly? I go, for what? He goes, I have boxes in my car of receipts. I was like, oh my God, I almost had a heart attack. I said, you have boxes of receipts? Like, you need a dolly? Like, this is serious business, right? We got to get ourselves organized. You got to have good record keeping. How many of you have your record keeping on some type of record keeping system? Okay, a few of you. All right. Definitely you want to do that. Get some type of record keeping system. It's really not that difficult anymore. There's so many different programs that you guys can use, apps on your phone. How many of you guys have millennials in your life? Does anybody have any young people in your life, millennials? No? The rest of you only have older people in your life? All right. If you guys have some millennials in your life, they know how to do everything. Every time my cell phone goes crazy, I just toss it to my son. And he's able to fix it so fast. Mom, you're getting old. I'm like, okay, just fix it, kid. Like, he's able to do some tricks and it just comes back to life, right? Yeah. Millennials know how to do everything. If you don't know a millennial, adopt a millennial. They will help you get your life in order, right? You don't want your records to be muddled. Some of you are putting your personal expenses in with your rental expenses. Your rents are going into your personal bank account. You're paying all the expenses all out of the same account. You're transferring money from over here. You're borrowing from over there. Checks here. This is on a credit card. This was on the debit card. I don't even know what card that one was on, right? Mm-hmm. If you guys are doing that type of record keeping, if you're audited, you know what's going to happen? IRS is going to ask for all of your bank statements, all of your credit card statements, and you're going to expose them to things that you may not want them to see. Keep your record keeping straight. If you have rental property, whether it's one separate personal bank account or not, separate it. Your personal expenses over here, your business expenses over here. Why do you think I want you to do that? Anybody? You don't want to commingle, but there's reasons why I don't want you to commingle. The reason why I don't want you to commingle is because if I want to say to IRS, all of this over here is business, I don't want to say, and this over here is personal, and, oh yeah, there's some business over here too. You follow me? A person that's really thoughtful and really a business owner, they're going to put all their business expenses in one bucket. So I can say all of this is his business stuff. All of this is his personal stuff. And when it's real clean, you can't tell me, Uncle Sam, that this is not business over here because he only puts his business stuff through this account. Very strategic. You follow me? So I would highly recommend at a minimum that you at least have 2 accounts if you have rental property. At least have 2 accounts. At a minimum. Okay? Are you guys with me on that?
Yes.
Get rid of the shoebox. How many of you guys got receipts somewhere stuck? Come on, tell me true. Yeah. See, those are the courageous people, right? I know. Get rid of those receipts stuck everywhere. They're in this folder, and they balled up here, and they're in a card, and they're in a purse. And I honestly, I can fill my purse up with receipts too, right? I can. But I do, on a daily basis, pull everything out and organize it.
Daily?
Daily. I have so much stuff going on daily. I have to do it on a daily basis.
Is a check a receipt?
A check is not a receipt. A check is a source document as to how you pay. We pay by checks. We pay by credit cards. We pay by cash, not so really. I said not so really, so stay away from paying by cash. Those are source documents in terms of how you pay. A receipt is the actual thing that you get from the person you do pay, right? That's a receipt. Now, some people may not give you receipts, all right? So what I do, because I have rental property and I get it with people that don't want, all the little things that go on, I'm gonna write a receipt, right? I have a triplicate receipt book. Here's your copy, here's my copy. So that you have some type of documentation. right? No, I don't make them sign it, but there's something in the tax code that says a copious record. So if I have a receipt book that's numbered and it's a copious record, meaning I'm not deleting pages out of it, it's going down, and every time I pay somebody by cash or check, if I write a receipt and I can show that I do that consistently, that's going to work just as well. Okay? So make sure you do that. Are you guys with me on that? A check, so in the event that you were audited, you're going to come with your receipts and your method of payment. If your method of payment is by check, you're going to bring the canceled check and you're going to bring the receipt that matches to it, right? If you pay by credit card, you're going to bring the credit card statement and the credit card slip, a receipt that matches to it. You need to have those two things. Very important. Now, is IRS always going to disallow your expenses if you don't have the receipt? No, they're not going to always disallow your expenses if you don't have the receipt. But, if you really want to take your expenses using Code Section 162 and really drop your taxes, you want to be in compliance. You want to have it. You don't want to give them a reason to question it. Let's not even give them a reason, right? We said we wanted to follow the law. The law says we need it. Let's just keep it. That's just the simplest way to handle it. Make sense to you guys? All right. Is this helpful a little bit? All right. You're welcome. All right. So, why do you guys think the wealthy people stay wealthy?
They take all their deductions.
I like you. They keep all their, did you say they keep all their receipts in a shoebox? I don't know what I'm going to do with you. And they got a lot of shoe boxes, right? They keep all their receipts in a shoebox organized. They can afford to hire the best people. Okay? What else?
They have information. They just know.
They have information. The only thing that separates us from other people is knowledge. Right? Work, yeah. Work. But typically, if we know what to do, we're going to figure out how to do it. We might not get it 100%, but we're going to fall past 50, 60, 70% if we know what to do. Have you guys just ever been really frustrated, like not knowing what to do with something? But once time somebody told you what to do, you're like, if somebody would just tell me what I need to do, I can get it done, right? So we're going to do what we need to do if we know that it could be done, right? If we know that there's a solution, we're going to get to the solution. But the problem that we run into is that we as taxpayers have not been taught to use the tax code. We haven't been taught that. You don't learn that in school. I didn't learn that when I was getting my undergrad degree in accounting. I ditched every tax class. Like I got this up close relationship with my dean of students. I was his pet student, honestly. And I told him, I said, I don't want to take a tax class. Can I get out of tax? He goes, you can take controllership. And so he signed me out of tax and I took controllership. Then when I graduated college, you know where I landed? My first job was in a tax law firm. Can you believe it? Without any tax knowledge whatsoever, but they were looking for somebody with an accounting background. So they don't teach us tax law, tax code when you're getting your accounting degree. You're not taught that. So that's just the way it works. So the wealthy stay wealthy because number one, they're organized, and number two, they're strategically not paying taxes. Love it or hate it, and this is not for political commentary, love it or hate it, we hear every day about these tax returns that we're never going to get, right? And that this individual is not paying any taxes. Honestly, these people are not paying taxes legally. That is just how it is. When I worked for the tax law firm, what they did was work with individuals, business owners that had property and businesses, and these individuals didn't pay tax, and it was legal. Because of the knowledge that that firm had, they used for their clients legally avoided tax. Understanding the tax code. So that's what I want you guys to understand. My philosophy is you should pay your fair share, right? And who determines our fair share? The tax code. tells us what our fair share is based on the law. And once I pay my fair share, I'm not leaving Uncle Sam a tip. That's it. You go get your fair share, but you're not getting any more from me. So when you guys get, for example, your DMV registration, you guys know you pay your little DMV registration, right? Do you send extra money in? How many of you send extra money in with your DMV registration? Nobody, right? When you guys pay your property taxes, do you guys add an extra $1,000? No, right? You pay exactly what you should pay. Well, that's the way taxes should be. You should pay exactly what you should pay. So let me tell you how you can keep more money in your pocket, and you really need to write this down. This is truly the key that is going to unlock the gate to lower your tax bill. There are 6 prongs to strategic tax planning. There are 6 prongs to strategic tax planning. And this is what I learned at the law firm, and this is what I employ in my practice today. I had a great time at the law firm. I learned so much at the law firm. Honestly, it was the best job that I had. When I first graduated college, my degree in accounting, most of my peers went to work for a CPA firm, a certified public accounting firm. And I landed a job in a law firm, and I was thinking to myself, gosh, I went to school for 4 years, a degree in accounting, and here I am in a law firm working as an administrative person. But little did I know that was the best second education that I could have ever received, because I worked with very smart attorneys. I would type up all the briefs, I would read everything, and I learned so much from being in that law firm. Went to school, got my master's in tax law, and decided that when I opened my practice, that I would open a practice that was doing what the law firm did. All right, so step number 1, I'm gonna just keep pouncing this, is you gotta get organized. And let me tell you guys a real quick way to get organized. If you're not organized, here's a real simple way to get organized. We have 12 months of the year, so I call it my 12 by 12. Take 12 days and go month by month. 12 days, month by month. So start with January 2018. Go back through your credit card statements, go back through your bank statements, look at your appointment books, go back through all of your stuff month by month. That's going to help you to get organized. Start pulling receipts, start jotting things down, start putting checks. That could be a tax write-off. Get yourselves organized, at least from that perspective, right? That will help you. Take 12 days to do it. So you don't get overwhelmed. You don't have the whole dining room table covered with receipts, right? Company comes, you have to throw the stuff someplace else, and it gets all mixed up. You don't have to be stressed out, and you shouldn't be doing it the night before your tax appointment. All right, get organized. The very next thing is review your past history. So I'm going to walk you through a scenario. I used to suffer very heavily from migraine headaches. Very heavily from migraine headaches. So I went to the doctor, finally broke down, went to the doctor, and the very first thing the doctor asked me was about my past history. She wanted to know, had you ever suffered from migraine headaches before? Have you ever had anything similar? What is your health issues? Blah, blah, blah. The number one thing that you have to do to strategically plan is somebody has to look at your past history, your past tax returns. That's very important to understand your past, at least 3 years tax returns. I would like to see that. Why do you think that doctor asked me about my past history? To see if there's contributing factors, right? Exactly. What has happened in the past? I want to look at past tax returns to see what you've done in the past, what type of write-offs you had in the past, what went on in the past. Was the past correctly done? Is there anything from the past that I could pull into the future to help you? So the past is very important to setting a real firm foundation. You guys with me so far? So she went all through my past history, asked me a million questions and so forth. Then the very next thing the doctor did was assess my current situation. Carla, on a scale of 1 to 10, where do you think your headache's at? A 13, right? It's killing me. Like I'm getting dizzy, I'm getting nauseous. It's really comes on often. You know, what did you eat today? Is there something that you eat that triggers it? Can you tell me anything that is triggering these headaches? Like, I need to know your current situation. Are you currently stressed out? No, not stressed out. What, you have 4 boys? Are your 4 boys getting your nerves? No, because they know I'll kick them out. You know, you're married. Is your husband driving you crazy? No, because then I'll divorce him. You know, she asked me a litany of questions. She really wanted to understand my current situation. What type of stuff I eat. She asked me tons of questions. So, in doing a strategic plan to lower your tax bill, I need to understand your current situation. Your current situation, right? Very important. Some of you don't like to really tell your current situation because you think it's unique to you. It is, but if you're going to have somebody lower your taxes, you've got to tell them about your current situation. Very important. Whatever it is, it's important. And your current situation is about where you are right now with your income and expenses. Do you have any potential lawsuits? Have you paid estimated taxes? Are you currently in an audit? Whatever your current situation is, you've got to tell that person who's going to help you reduce your taxes. They got to know it, 100%. All of it. You can't hide anything from them, okay? Very important. Then, the very next thing the doctor asked me, Carla, I need to understand what you want to accomplish. I said, I need something to get rid of these headaches. I'm a tax person. I need to be sharp. I don't want to be on pain pills. Like, I really want to know what's causing these headaches. I want to get rid of the issue. I don't want to be on some medication. I don't want to go to the emergency room and you give me a bag of something that's going to knock me out for the next 3 days. I really need to know what's going on with these headaches. I want a true solution. Some people are like, write me a prescription. I'm not that girl. I don't want a prescription. I really want to know what's driving these migraines. So she was like, okay, if you really want to know what's driving these migraines, you're really going to have to work with me for a week. Like, I need you to diary every single thing you eat. Your environment, like what's in it. Did you change detergents? Do you put on certain perfumes, colognes? I mean, she took me through the whole forest and over the river and back. The key is whomever's going to help you lower your tax bill has to understand your vision. What are you trying to accomplish? I'll hear clients say to me, Carla, well, I just want to lower my taxes. Okay, I get that part. I completely understand that. But what else are you trying to do? Are you trying to buy more rental property? Are you trying to put your kids in college? Are you trying to up-level your rental property? Maybe you have single families. Maybe you have residential. Maybe you want to go to commercial. Maybe you want to buy out of state. Maybe you want to get married. Maybe you want to divorce your husband. Maybe you want 2 husbands. I don't know, ladies. I'm just saying, right? Whatever it is, I got to understand it. Maybe you need to go get a loan. Because if I drop your tax bill and I don't drop it according to your vision, then what's going to happen? You might not be able to get a loan. You might not be able to get your kid in college. You might not be able to get that financial aid. You might not be able to get that divorce. You might get it, but you might have to pay a lot of money, right? It's important that I know, because the way that we'll structure your situation is going to be predicated upon your vision, not upon Google's vision. All right? And I say that, you laugh, but I say that. How many of you guys Google for answers? Come on, admit it, knock it off. Yeah, right? A lot of us are Googling for answers. We're asking Google, what should I do? Google, should I be an LLC or an S Corp? Google, is this right off the board or not? Google, will IRS audit me, right? That's what clients do all the time. Google is great, but Google's just a reference. It's just a reference. Google doesn't have exacto knife answers. Even though if you ask Alexa, Siri, and all these people a joke, they'll come back with something. That's just pre-programmed answers. Very important to understand that your situation is unique from anybody else's. Even though you may have friends, and you may say, oh, well, you know, me and my friends, we bought our rental property at the same time, and our situations are just alike. I guarantee you their situations are not just alike. There's something different. Your situation is like DNA. It's different. So you've got to get the right answer based on your vision. Then, once we review the past, once we assess the current situation, once I understand your vision, then I could implement the right strategies. Then I could tell you whether you should be an LLC. whether you should have multiple LLCs. I get this question a lot. Carla, should I have one LLC for my property, or should I have multiple LLCs? Carla, should I open my LLC in Nevada? Should I open it in, what's that, Delaware? I mean, I get all these questions. What, there you go, Wyoming. That's the other one, all the time. Because I read on Google that you should do that. That these laws favor, landlords, right? Should you do that? Depends. Depends on what your situation is. I don't know if you should do that or not. And I'm not going to ill-advise you, because it's not just a black and white answer. It's an answer predicated upon your bigger picture. Your bigger picture, what your goals are. And we'll look 3 to 5 years forward, but then when we get there, it might change, right? It could change. Nothing is in stone. So you got to always be thinking that just because I set this situation up 2 years ago doesn't mean it's going to be the same right now. Make sense? So you got to be thoughtful in your process. And then the next thing you got to do is you got to continue the conversation. If you are working with your tax professional and you're only seeing your tax professional one time a year, I don't know how helpful they're being. If you're only seeing them one time a year. But that's how we've been taught, right? We've been taught to go see them one time a year. We've been taught to send them their information, and then they put it in the system and they spit something out for you, right?
Yes.
But if you really want to be healthy, should you go see your doctor maybe more than once a year, right? You should. How many of you love going to the dentist? Nobody raised their hand. But if you go to the dentist, what do? They give you that card that says come back in 6 more months so we can do that teeth cleaning again, right? So even you go to your dentist, I hate the dentist, but I go because I don't want to end up with the I can't say that dental sound. Oh my God, it's terrible. You gotta go talk to your tax person, and hopefully the person you talk to, you like them, right? A little bit. How many of you guys like your tax person?
Too expensive.
Your tax person too expensive. Would you guys eat with your tax person, break bread with them? All right, you should. You should. Because if you don't have that type of relationship with them, where you're comfortable enough to have a conversation with them, break bread with them, I don't know. That means you're giving a complete stranger, somebody you're not even comfortable with, your information. You build a relationship with your doctor, right? You build a relationship with your dentist, not that we really want one. I don't want a relationship with my dentist, but I have one. I actually like my dentist. I changed dentists recently because my other dentist drove me bananas. But I have a great dentist. When I go to my dental office now, she gives me headphones, so I can listen to headphones, and it's like always, she puts on like a warm blanket, like I have dental anxiety. And when you look up at the sky, there's like a thing. It looks like the sky. Beautiful dental office. Bottom line is, you guys have to have conversations. In the tax world, this is what we say. And I don't care what tax person you talk to, this is what happens in the tax world. If you're going to a tax person, especially for the very first time, if you're going to a tax person sometime between January and February 15th, you're walking in the emergency room. Walking in the emergency room. If you're coming between February 15th and March 15th, you're coming in the emergency room in a wheelchair. March 15th, April 15th, you're on a gurney. After April 15th, they're doing those shock things, right? Trying to bring you back. The key is that if you give that person enough time, enough runway, they can help you, but an hour tax preparation appointment is not going to do it. Are you guys with me? All right. I am going to open it up. Let's see what time it is. All right, 11:30 prompt. And I didn't even have the timer on. All right, I'm going to open it up.